So we continue our series of Meet the Manager videos today as we're joined by Phil Pearson. Phil's a experienced equity investor and currently co-manager of the GLG Technology Equity Fund, a new fund on our recommended list of funds. Phil, thanks very much for joining us today. I wondered if to kick off, you could just summarise what the actual investment objectives of the fund are and also how you define your investment universe.
Sure. So we took over the product back in 2009, and my background before then was very much an absolute return background, a hedge fund background. So the real aim of this product was to create an absolute return mindset to a long-only environment in the technology sector. Now, we've called it the Technology Fund. Realistically speaking, we deliberately created a broad enough universe of stocks that we could look for non-correlated assets and some defensive as well as sort of offensive investment opportunities to cover all remits. So we've deliberately included, it's a global product, but we deliberately included telecom, media, and technology. And think technology in more the traditional sense. You won't really see biotech, medtech, solar type things. It tends to be much more the traditional technology that you'd think about, software, internet services, and hardware. And then, as I say, from a European perspective, there'll be a lot of focus on telcos, and globally we look across the whole universe there.
Sure. So a big part of your investment process is doing some fundamental analysis on the stocks that you look at, and then comparing that to market consensus. So that looking at that arbitrage between what you think is reality to perception. I wonder if you can just briefly explain how that works in practice.
Well, I think the universe is quite a big universe if you think about it globally in those industries. So that a starting premise is really to look for asymmetric returns. That's ultimately what we aim to deliver with the product. So our starting point is a screening process, which, as you described, really requires us to think about both perception and reality, because we're looking for mismatches to start doing our work. Thinking about that practically, a lot of investors that we talk to, and I'm sure you're very familiar with, spend a lot of time talking about the fundamental research they're doing, all of which we do. So it's understanding supply-demand balance, competitive landscape shifts, and changes in business models, and we're looking at those real time. And then they tend to draw a valuation on top of that. We tend to start a slightly different approach, which is we'll look at those fundamentals. We'll then compare those by talking and looking at the flow. GLG is one of the largest commission payers on the planet, and we tend to spend a lot of time talking to the sell side, getting a better picture really of what people think is reality versus what we think is reality. And we're looking for anomalies. Once we've got those anomalies, or we've identified something that looks like the perception of reality is mismatched, we then try and model scenarios. So instead of saying, we think this company has a fair value of X, we tend to build multiple scenarios where what and how would the market value this asset, depending on the different scenarios that might occur, and we model out what we call a probability envelope. And we're looking to find and identify those probability envelopes that are the most asymmetric. Because in the end, where we tend to take our biggest bets is not necessarily in stocks where we think have the most upside, but in things where we have the best balanced risk return, asymmetric upside versus downside. We tend to try and aim to lose much less when we're wrong than we make when we're right. And the whole process is designed and to deliver that aim.
Sure. So do you think sort of thematically, I mean, are there themes in the portfolio that you're playing currently?
There are. They tend not to be top-down driven. They tend to, as we go about that business of looking at perception and reality, it tends to flash up areas of change which we think the market might be misvaluing or misunderstanding. There's multiple examples that are in the portfolio right now. I mean, tech is an interesting sector in its own right, traditional tech, in the sense that people think about it as very fast-moving, very innovative. Actually, it tends to be long periods of a defined environment with very dominant winners and losers, with supply-demand balances overarching, and then sudden periods of very big disruption, which then, if you like, burns the old crop, refertilizes the land, and out comes new growth. We're kind of in one of those phases where through 2009 to 2012-13, we went through a big transition in the technology market as people transitioned the main compute device from a fixed world that we're all familiar with, the PC environment, into a mobile world, if you like, the iPhone world that subsequently came out of it. That period of disruption then has created a very interesting landscape, which is creating a lot of changes underlying in subsectors, and that period of innovation is something that we're looking to exploit a lot. So we can think about examples. You hear lots of people talking about the cloud, about software as a service, about big data and data analytics, Internet 2.0, if you think the more social networking environment, lots of things going on there. Outside of tech, there's a lot of changes in the telecom environment as well.
Sure. So if we delve a little bit deeper, maybe choose a particular stock or subsector that you have a particularly high conviction in, or represents a significant exposure in your portfolio currently.
Sure. So normally in these scenarios we talk about, and I'm sure in future times we would talk about some of the stuff going on in technology, but I think it's well covered. I think what's very topical right now, and what we've made a lot of changes to in the last 6 months, is we've put a lot of capital to work in the telecom sector for the first time in a long time, and actually very specifically in the European telecoms marketplace. It's an area where we've not been invested for much of the last 4 or 5 years, as we've seen a lot of value destruction there, but there seems to be a lot of changes. And the changes are really stimulated by a few different areas. The first and foremost is the regulatory environment in Europe has been a miserable environment for the last decade or so, where Brussels has been very keen to make sure that competition is created in the eyes of the consumer through pricing being driven down, and that's resulted in a very difficult environment. However, I think what they've come to realise as they've looked across the pond at the US in particular is that concentrated market of 2 dominant suppliers and a couple of others, but a very consolidated landscape, has resulted in much more investment in broadband infrastructure and in faster wireless speeds. So we've seen a desire by the European regulators to allow consolidation. Now we've seen in the UK, we've seen in Spain, in Portugal, in Germany, and no doubt we will see soon, I think, in Italy and in France, consolidation of the players. What's that then coincidentally has come at the same time is it's come at a time where we're starting to see real adoption finally of real data usage in the mobile networks, which in the US has been there and prevalent now for 4 or 5 years, but really in Europe we're still in the environment where up until a year ago data usage was depressingly low, sub a couple of 100 megabits a month of usage, really a very low level. We've now moved into an environment where with larger screen phones, particularly from Apple, but also from Samsung, video, which we're seeing streamed through Facebook, etc., a lot more usage. That's allowing this consolidated environment to start to see revenue growth for the first time in Vodafone's example, which is the largest mobile operator in Europe. We think they'll guide shortly to revenue growth for the first time in 7 years. Now, the reason why that's important, they're very financially leveraged, very operatingly leveraged. 2% revenue growth probably equates to about 10% free cash flow growth for those companies. And in an environment where debt's cheap, leverage is there, the ability for us as shareholders to start to see very dramatic growth in shareholder returns through that period is quite high. And the mismodelling, I think, is just the fact it's been certainly 7 years of declining revenues in an industry where it's quite difficult to believe it's really changed for the better, but I think there's a lot of evidence to suggest it has.
Okay, great. One thing that we're conscious of and look at quite closely at Killick is the level of personal alignment that a manager has with other unit holders. I wonder if you could maybe explain how that works at GLG and sort of how that incentive scheme works.
Yeah, with GLG, it's every manager has a slightly different structure. Ours is really quite simple. The slight complication for me is I run both this long-only fund, but I also run a very large long-short book as well, where with exactly the same strategic aim and certainly the same process. So the long book of my long-short book looks very similar to my long book of my long-only. As I'm sure many of you guys are well aware, the fee structure in the long-short is very much higher and very performance-driven relative to the fee structure in the long-only world, which is to a large degree a percentage of money we run rather than percentage of money we make. So the majority of my compensation is based on the actual performance fee generated out of the long-short fund, which is very correlated to the alpha we generated on the long-only fund, extremely correlated. So it's actually a very mechanical formula. A percentage of what we make is what we pay. On top of that, we do get a cut of the management fee on the long-only fund. But to be clear, it's dramatically driven really by our performance rather than the assets that we gather in its totality. In addition, I own a significant investment in the long-only fund from a personal perspective.
Great. Well, Phil, thanks very much for joining us today. If you want any more detail on the GLG Technology Equity Fund, please contact your broker for a copy of that recent research note. Thanks very much.